As a dividend growth investor, we want to know one thing. Is the dividend that this company is paying out sustainable, and will they be able to keep raising their dividends like they did in the past? But for that, you have to research the company. As a beginning dividend investor, everyone was telling me to do my research and to do my due diligence before buying a dividend stock. But nobody was telling me how to do that exactly. I did a lot of Google searches, I checked on YouTube, but I couldn't find one good resource to find a step-by-step guide on how to research a dividend company. Then I started reading several books on the topic of dividend growth investing, and I found good information here and there. But still, no blueprint on how to do proper research into a dividend paying company. And that is why I decided to do something about it by creating these video series. In this series I will go over the different methods of researching dividend stocks, which metrics I like to look at and what they mean. Today specifically you will know at the end of this video how to read an income statement line by line, why that is an important skill to master and what it all means for us dividend growth investors. In the last video I discussed how to find dividend paying companies and creating a watch list out of them. Today is the start of finding out if those dividend paying companies can go from our watch list to our buy list based on our criteria. Besides going over the research process today, I will also show you the performance of my portfolio over the last couple of volatile days, as well as an overview of the dividends that came in February. So let's get started. So, you've found dividend paying companies that you like. If you've watched the previous episode, episode 5, then you know where to find those dividend paying companies and that you should put them on your watch list. Don't have a watch list? Watch video 5 to find out how to create one and how to populate it. But there's a problem after that. How do you know if those companies that you found are good companies to invest in? After all, you wouldn't buy a house either without doing some proper research, would you? You would do a proper building inspection, you would probably check out the neighborhood, you'd probably visit the house, etc. etc. How does that work with dividend paying stocks? There are two parts to analyzing, qualitative and quantitative analysis. So the qualitative analysis is about things like what does the company do, what is their mode, their competitive advantage, or their competitors, where do they operate and what business segments do they have, etc. etc. The quantitative analysis is more about the raw numbers. How much sales, revenue, and how does it trend over time? How much margin do they have and how does it trend over time? How much debt do they have? What does their dividend history look like, etc. etc. So the goal after the analysis is to see if a company can go from our watch list to our buy list. And after that we will see if a company is currently undervalued, overvalued, or fairly valued to determine if we're gonna buy it right now or if we're gonna wait for a dip. This video will be part of a series. That is to be able to cover all aspects in enough detail, but to keep the video in reasonable bite-sized chunks for you to digest, because the goal of this series is to go deep into the process of researching companies. And as I've talked about previously, there are two parts, quantitative analysis and qualitative analysis. In quantitative analysis, and that's the part we will be talking about today, I made a distinction between financial information, dividend information, and valuation information. And specifically today, we're gonna talk about the financials information. Under the financials information we have the income statement, the balance sheet, and the cash flow. And today we're going to talk about the income statement. And in the next video I will talk about the balance sheet. And of course, the best way to stay up to date is by hitting that subscribe button and hitting the little bell next to it to get your notifications when a new video comes out. What is the income statement actually? Income statement shows the profits and losses that a company makes over time in a particular time frame. It is contrary to the balance sheet, which shows the snapshots of the company's financials particular date. I will be going over the items on the income statement as they appear in logical order. I will use Morningstar to show the income statement. Now there's a few things to remember. These metrics I use are not set in stone, and I believe that everyone should figure out what works for them. Rather, you should see it as a framework that I'm providing here that you can expand on or deduct from. So the goal here is to get a grasp on the financial status of a company, see if there are any areas that we need to further assess. I would compare it like reading a book, where the story is slowly unfolding the more you read about it. So for example, if the revenue is down over a certain period, we can further look into that by checking out the quarterly or the annual reports, see what is going on, and to see if we can find an explanation for that. Based on that, we can determine what that means for the long term. So here we have the income statement. Whew, that looks kinda boring and complicated, doesn't it? All those numbers. Don't worry, I got you covered here. I will take you through it step by step. So first we're going to start with the revenue. This example I'm using the company 3M, or symbol MMM. The revenue is often referred to as the top line growth on earnings calls. That is because it is at the top of the income statement and that is where it all starts for a company. If there's no revenue, then there's no right to exist for a company. So basically the revenue is the total amount of money a company makes by selling products to its customers. So what I like to look at is how the revenue compares from the most recent year to the year before that. The revenue of 3M was 32 billion in 2019. If we compare that to 2018, we can see that it was actually at 32.7, so that's a slight decline. That's definitely something that we're gonna look into at a later stage. But for now, it's to take note of. But what we can see is that compared to 2017 and earlier, revenue is still up. So after I've compared the most recent reported year to the previous year, so 2019 to 2018 in this case, I would like to see how it trends over time. So 5 years back and 10 years back, what I like to do is to export data to Google Sheets. So I can make a trend line and take a look at how it is trending. So let's do that now. I actually take the export from the key ratios tab because all the information that I need is on there. So I'll export it and then I paste it onto this tab in my Google Sheet. So here I have a overview of the revenue trend over the last 10 years. You can see here that it is not consistently going up, but you can see that in 2010, 2011, 2012, 13, 14 was going up, then there was a slight decline, and then it was going up again, and then 2019 there was a slight decline again as well. So this company 3M seems to be cyclical, and that's something to look into further to see if that is actually the case. But for now we're just gonna take note of it and go on with our research. Next up is the gross profit. Gross profit is the revenue minus the cost of goods sold, or the cost of revenue as it is displayed here on Morningstar. The cost of goods sold is how much it costs for the company to produce their products. So the gross profit is the money a company makes before adding additional expenses like research and development, sales and administration. So looking at this income statement is like unpeeling an onion. The outside is the revenue, because there is where it starts. Then the cost of making those products are deducted and you end up with the gross profit. So what does it tell us if the gross profit is up but the revenue is down? It means the company has become more efficient in producing their products because it has cost them less than previously to produce those products. In the case of 3M, we can see that both the revenue, so the top line, and the gross profit went down in 2019 compared to 2018, and we can actually see that the gross profit went down a bit more than the revenue, so they've become less efficient in producing their products. But we can see the same trend here as with revenue. From 2015, 2016, 2017, 2018 it was increasing and then it decreased in 2019. So the next item on the income statement we're going to take a look at is the operating income or operating profit. So in contrast to gross profit, this includes the deduction of additional expenses that are also needed to run a business, like research and development, sales, marketing, etc. And again, you can see the story unfolding here. First we had revenue, which was for 2019 at 32.1 billion. Then the cost of revenue was deducted and we ended up with a gross profit of 15 billion. Then the operating expenses were deducted, so 1.9 for research and development, 7 billion for sales, marketing and administration, etc. with a total of 8.9 for total operating expenses. And after that we landed on an operating income of just over 6 billion. So the operating profit can be increasing while the revenue is decreasing, and that is of course when the operating expenses are less than they were before, so when the operating expenses are reduced, and that is usually the result of cost-cutting measures like layoffs, but also the result of making processes more efficient within a company. But you can only keep that up for so long, because at some point the revenue will have to start increasing again. You can only cut so much costs before it becomes inefficient. And again, we want to compare the operating income to the previous year of 2018. So we can see that there was also a decline compared to 2018 in operating income. If we take a look back further, we can see there was a spike in 2017, and then in 2018 and 2019 it went down. So can we see what has caused that? Well, let's take a look. Well, first of all, you can see that from 2017 to 2018 and 2019 that the cost of revenue has increased, so they have become less efficient with producing their products. What we can also see is that if we compare 2017 to 2019, research and development has increased, and actually research and development is a very important thing for a company like 3M because that is what fuels their future profits, their future revenue. So I don't mind seeing those costs go up that much. And we can also see that compared to 2017, the cost of sales and administration and marketing also went up. So that explains the decreasing operating income. That can be fine for a while, but we would have to take a look back further how it developed in the past to see if this is a normal trend or that something is wrong. Another metric to look at is the gross margin. Gross margin is basically the difference between the revenue, so the sales, and the cost of producing the products in a percentage. So if a company sells the product for €10 and it costs them €5 to produce it, then gross margin is 50%. On Morningstar you can find the gross margin in percentage easily on the key ratios tab, but you can also calculate it yourself with the formula I just gave you. So if we take a look at the gross margin of 3M, we can see that compared to 2018, in 2019 the gross margin decreased by 3% almost. 2.5. If we compare it to the trend over the years, we can see that 2010 it was 48.1%, then it went down. In 2016 it was at 50%, which is really good, and then it slightly declined again to 46.7%. What I would like to see is a gross margin in a range of 25 to 50%, because the higher the gross margin, the less the risk. It leaves more margin for error. So for example, if the cost of producing the products goes up, you have a bigger margin of error and it won't impact the company to the point where it's not making any profit. So an example of expenses that could impact the gross margin are costs of material used. Besides the gross margin, there's also the operating margin. Operating margin measures how much profit the company makes on a dollar of revenue after paying for variable costs of production like wages, raw materials, R&D, etc. but before interest and taxes. The operating margin can be calculated by dividing operating income by the revenue. On Morningstar, the operating margin can be found on the key ratios tab as well. And if we take a look at the operating margin of 3M, we can see that the last few years the operating margin has come down. So from 2016 it was 24.0, then it went down. Now in 2019 it was at 18.9. So that is definitely something to look at and to research further. Now if we go back to the financials tab, we can actually see why the operating margin has declined, because both the cost of revenue and the total operating expenses have increased over the years. So if we take again 2016, we can see the cost of revenue went up from 15 billion to 17.1 billion in 2019. Same for operating expenses. So the real question is, why did those expenses increase? And that is something to look into further in a later stage. And then the net income. This is what is also known as the bottom line profit. This is what is left over for a company after all the expenses are deducted. And more importantly for us dividend investors, this is the money that will be used to, among other things, pay the dividends with, but also for example to pay down debt. What is left over after that will be retained, so that's called retained earnings. So getting back to the unpeeling of the onion, this is the last layer. If we take 2019, first we had the revenue, then the cost of revenue was deducted to land on the gross profit, and then the operating expenses were deducted to land on the operating income, and lastly the interest expenses and the taxes were deducted to land on the net income. So as you can see here, it all starts with sales, with the revenue. That's why it's so important, because without the revenue there's no right of existence for a company. And then it trickles down and all the expenses are deducted, and then you land on the net income, which is the profit. Like I said, what is known as the bottom line profit. So whenever you hear someone talk about the bottom line profit in earnings call, that is what they are talking about. So again, what I like to look at here is how the net income is trending over time, and starting with the last known year compared to the previous year, we can see that also the net income has decreased compared to 2018. If again we go to our Google Sheet to see how it is trending over time, we can see that from 2010 to 2019, first there was an uptrend, then there was a bit of fluctuation, then there was a good year in 2018, and in 2019 it went down quite a bit, and as you can see here, it went down by 14.6%. 14.5%, so that's quite a lot. So like I said, the net income also includes taxes and interest. So if the net income increased less or decreased more than the operating income, something happened on the taxes and interest side. And actually with 3M, we can see that because the operating income went down from 2018 to 2019 by 9%, and the net income went down by 14.5%. So that's quite a big difference of 6%. And we can see here that the bulk of that difference between the operating income and the net income is coming from the interest expense, or actually the other income expense. But that's the reason for the big difference between the decline in operating income and the decline in net income. So getting back to the net income trend, this is actually a trend that we would not like to see. At least the trend from 2018 to 2019, from plus 10% to minus 14.5%, because that means in the long term they can also not keep up their dividend increases. So if income is decreasing, net income is decreasing, over time they won't be able to increase the dividends. So what we would like to see is that over time they increase their net income by at least the 5% that we want from our dividend growth to be able to sustainably raise their dividends, because like I said, the dividend increases are coming directly from the net income. So that means if the net income is not increasing 5% over a longer period of time, the payout ratio will start to increase. Now the payout ratio can be calculated by dividing the dividends paid out by the net income. Another way to calculate it is on a per share basis. So then you would divide the dividends per share by the earnings per share. So to get a better feel of the increase in net income over a longer period of time, I calculated the difference between 2010 and 2015, and then 2010 and 2019. You can see between 2010 and 2015 the net income increased by 18.3% total. From 2010 to 2019 net income increased from 4 to 4.5, so that's a 11.87% increase. That's a yearly increase of 1.19%. So that would mean that to have a sustainable dividend increase, it should be only 1.19% per year, which is of course not very good. So what we probably see with 3M is that their payout ratio has increased. And if we go to Seeking Alpha, sure enough, we can see that the payout ratio has increased. You can see that from 2015 it was 47%. Right now it is at almost 63%. So you can see clearly that the payout ratio has increased. And lastly, we have the earnings per share on the income statement. This is basically the same as the net income divided by the amount of outstanding shares. However, if a company is buying back shares, that will artificially increase the earnings per share. So the earnings per share can actually grow while the net income is declining, because stock buybacks are often funded by debt. That is usually not a good sign. So let's take a look at the income statement of 3M. You can see that there are two lines under the earnings per share: the basic earnings per share and the diluted earnings per share. The basic earnings per share are the earnings per share that come from dividing the net income by the total amount of outstanding shares. And the diluted earnings per share take into account the possibility that convertible securities, such as convertible preferred shares and equity options, those are mainly employee-based options, are exercised, but the merger or acquisition can also result in more shares being issued. When such convertible securities were to be exercised, the total amount of outstanding shares would increase, and this would mean that the already outstanding shares are worth less. The business stays the same, but it has to be broken up into more pieces, so the profit per share is less, and that is why it's called diluted earnings per share. So you could say that the diluted earnings per share is a more safe and true measure of displaying earnings per share in most cases, because it takes into account the possible scenario that that amount of outstanding shares will increase, and the diluted earnings per share is actually the measure we will use in future calculations. And if we take a look at the trend of earnings per share, we can see that from 2010 it went from 5.63 until 7.89 in 2019, and from 2015 until 2019 it went from 7.58 to 7.89. But you can see that it was actually lower in 2019 than it was in 2016, in 2017, and also 2018. So that's generally not a good sign. So let's take a look first at my portfolio. For those that are new to this channel, this portfolio consists of dividend growth companies. So those are companies that are not only paying out dividends, but they're also increasing it periodically, usually once a year. So What a week it was. Lots of volatility, record down days, record up days, the next day, and then reversed again. Days like these, it's good to remind yourself of the long-term view. And for us dividend investors, to keep your eye on the ball, the dividends. So a quick overview of my portfolio. You can see that in 2020, my portfolio in Bing is down 11.6%. Almost 1,000 euros. You can see I have 9 companies in this portfolio. I won't go over all of them because I've mentioned them in previous videos already. So if you're interested in that, I would suggest you to watch the first video where I go over them briefly. If we briefly take a look at the return in 2020, the green line is my portfolio. The green line is my portfolio and the blue line is the S&P 500. So what we can see here is that my portfolio is actually down more than the S&P 500. So that could be a sign that my portfolio is less recession resistant. So that's something to consider for myself. If we then take a look at the long-term view, so since inception of this portfolio, the bleep here, but if we go back to 2018, end of 2018, you can see kind of the same thing happened there, but here the drop is bigger. Since inception, my portfolio is now at 23% and the benchmark is at 26.6%. That is excluding dividends. We'll take a look at that later. Mind you, this video is recorded before the opening on Monday, so we could see some more volatility today. If we then go to my other portfolio in the Giro, there's actually one more company. I purchased 3M last week, so now I have a total of 2 companies, 3M and Tonsure Factory Outlets. The total account value is now at almost 1,100 euros after the purchase. And then in Google Sheets we can see the 2 portfolios combined. I'll go over them quickly. Cost basis is at 8,300 now. Value is at 9,300. The change without dividends is 12.6%. Change with dividends included is 21% since inception. And the annual income is now at around $52. And then the stuff we're supposed to keep our eyes on, the dividends. So in February, you can see that I received a dividend payment of $70.50, an increase of almost 34% year on year. If we take a look at the graph of actual monthly income, the graph is actually breaking out. So you can see here that it went to 70.50 compared to 53.60, and that's mainly due to my purchase of SKT. This dividend sheet is actually made by Joseph Carlson, and I'll put a link to it in the description where you can find it. And another cool thing I would like to show you is an app called My Dividends. I have no connections with them other than me being a user, but I think it's quite a cool app, so I want to show you. So you can see here in a glance the annual dividends, the quarterly dividends, and even the monthly and hourly dividends. That was it for today. Next time we will be going over the balance sheet, just like we did with the income statement today, line by line. So if you want to be notified as soon as that video comes out, hit the subscribe button and hit the little bell next to it to get a notification straight away. And also don't forget to like and comment on the video, because that will really help me getting the content out to more people. See you next time. Bye bye.